More interesting?
Let's talk about something juicier, and that is the state of your industry right now. Many LPs needing liquidity, and they need it now, and they need it badly. What are you seeing when you talk to clients?
Yeah, I think rumors of our death are sort of greatly exaggerated. So I think that the report from the FT yesterday I thought was a little overstated. I think what we are going to see is kind of that classic numerator-denominator issue. Denominator is clearly shrinking. We're seeing it everywhere. And so the public markets move much quicker than the private markets on valuations. So it looks like you're a little overexposed today. That will eventually sort itself out. Sophisticated investors know that going and selling illiquid funds in this kind of a market environment is going to bring you substantial discounts. So that tends not to be their first move. I think you'll certainly see fundraising, though, slow down.
IPOs, we thought that was the big exit route. Last year, didn't happen.
No.
This year, very unlikely to happen. No. So what is the exit option here? Is it secondaries, but at a discount?
I think you're
and a bigger discount than what we've seen so far?
Yeah, I think you'll see a few things. One, IPOs, even in a healthy market, are only a minority of the industry's overall exits. You're going to continue to see a lot of GP to GP sales, and you'll continue to see some single asset sort of transactions that are financed by LPs. But I think we should certainly expect to see liquidity slowing down. We've already seen it. I don't think it's going to get better anytime soon.
And it's the activity, isn't it? Like, a good investment is a good investment. The timescale has to change, though, has to adapt. And if there's log jams left, right, and centre because of this volatility, because of policy uncertainty, because of the sellers just thinking, I'm not taking this price now at the moment, and the same buyer strike, seller strike. This is exactly the root of the point. The uncertainty and the oscillation in policy is just damning for anyone who wants to be in this business at the moment, isn't it?
You have no one likes uncertainty, and so this whole buyer-seller getting them to agree today is going to be very difficult. That said, private markets have a lot of capital. Private markets like a deal, and private markets are going hunting. So we know those things are happening. The question is going to be, is someone going to capitulate and say, yes, today's the day I'm going to sell my business? I think that's unlikely. So I think what's more likely is we're going to see more rescue financing, distress financing, capital for growth.
Exact point.
So I think you're going to see a lot of that. The debt folks are going to be active. Yeah. They're going to be active on interesting lending strategies at much higher rates of return to some businesses who need capital to bridge some gaps, who are in a bit of a stress.
And there is a lot of stress out there as well, isn't there?
It's starting to form. I think.
Where are you seeing it most?
Yeah, so I think what you're seeing right now is it's more in the public sector, because if you think about the private markets, we're tending to not own huge multinational businesses. Those tend to be public. And so the private markets are already more regionally oriented, so you're not seeing the pain so prevalent today. We're seeing that coming. The bigger question is what's the consumer going to do? We're already seeing early signs of less travel, less hotel bookings, less restaurant bookings. So the consumer is already telling you
from Canada to the US.
Well, they don't want to come visit.
No, the numbers are enormous.
Oh, significant.
I saw a stat, I think it's from OAG or something, that the Canada to US bookings were down like 70% for the summer.
Huge. And if you think about seasonally when they tend to come visit our beaches in sort of April and May, sort of the Canadian summer. And so that impact is here, and it's here now.
So that's anecdotal evidence right now. Have you done your homework on the impact of the tariffs on your portfolio companies? A lot of GPs right now are saying, hey, we're trying to work through that. How much visibility have you got on what the impacts will be?
Yeah, so people are doing their homework. We're doing it. Our fund managers are doing it. I think right now the problem is this is like a really awful, nightmarish kind of multivariable calculus thing that you kind of wake up in sweats thinking about your time in high school. Too many variables, just too many variables for people to lock down. So right now people are trying to figure out magnitude, duration, sector, capitulation. And so right now I think it's hard for anyone to say with certainty this is exactly what's going to happen and happen when. We need to get some of the variables locked down.
Eric, you know what I wonder though, and you talked about the denominator effect before, and this takes us back all the way to 2022, a terrible year for the entire industry. Now, if you say that's going to be hitting some of the big institutionals, a lot of them, what about the private wealth market that you said is the big promise for your industry? To what extent are they hit by that as well? And what are they saying right now?
This is a great question, and I think this is going to be an interesting one to watch. What's happening right now has been private wealth has been really moving aggressively into the private markets. Why? better performance, and they haven't had access to it historically. So all of a sudden, there's this big new frontier that's been opened up to them in a way that just wasn't before. If you look at the typical retail investor's exposure to the private markets, today it's still essentially zero. So you're starting at a complete bottom base and moving up. So what does this environment do to them? I suspect this environment's actually going to cause them to move even more. That seems counter.
The democratization that everyone is talking about, that is still going forward?
It's here, it's real, that isn't changing. And if you think about volatility, I go back to my earlier comment, the private markets are going to be way less damaged by what's happening than the public markets. And so I think you're going to see a bit of a flight to safety. People are actually going to move into private credit, private infrastructure, more localized regional investing, all done in the private market. So I think you're going to continue to see strong wealth flows.
Is there a geographic bias to where the best value remains at the moment as well? Short term, the US may remain a better environment. Investment-wise, you're writing, but is medium to longer term, which is what you guys deal in?
Yeah, I think what we're looking at is, if you believe we're playing sort of the ultimate game of economic chicken and who's going to blink first here, if you sort of break down the regions, the US in theory, can withstand a trade battle for the longest period of time. Why? Trade represents, it's the smallest portion of GDP relative to other economies. So if it's US versus the EU, you'd want to bet on the US. But the idea that the US is going to outlast China, I think, is hard. Why? That's not an economic issue, that's a political issue. Do you believe, if you're going to run for 2 years with economic calamity, would you rather be Xi or Trump? In that scenario, I'd rather be Xi.
That's a brilliant point. You're basically saying we've got less than 2 years, or circa 2 years, for the next key event in the US calendar. And if the president loses either the Senate or the House or both, then it's game over?
Trump has another election to get through. Xi does not. So in the midterms, if you lose the House or the Senate or both, if you're Trump, you're right back into a world of inquiries and potential impeachment and more investigations. And he's been in that world. He doesn't like that world. I can't imagine he wants to go back to it.
Let me just say that very briefly, the French trade data has just broken negative 7.87 billion euros versus a revised 6.49 billion euros negative in January. I guess we're all going to get really excited about trade data from now on. It's normally an aside on the front as well. Okay, so he needs to move quickly, but I have a theory, and I expound this with Kara a little bit, that if there is one reason to be optimistic, it's not necessarily where the market's got to, it's not necessarily because there's going to be negotiations, it's because the backers of Trump are beginning to wobble. The people who thought he was the greatest thing since sliced bread, both in Congress and indeed on Wall Street, they're beginning to wobble about the method rather than the ultimate aim of redressing the balance. I think they all agree that they want to do that. Is that, in your eyes as well, actually meaningful? The fact that the money men and women and the political capital, the people who hold the political capital, are actually kind of getting worried now?
I think it only matters on the political side, not the economic side. Really? So I don't see sort of the pundits. He has a lot of money. I don't think that's going to be the primary motivator. I would look much more towards what's happening among political constituents and what that means for A, power to the Republican Party, and B, back to the midterm piece. That to me matters more than whether he's getting donations and monies into the PAC. A lot of that already exists, and I don't think that's the focus today.
And Kara's going to come in a minute, but I thought it was all about stock market, TV, and backers. People who really seem to know about how it works for Trump said how good you look on telly, how the stock market's responding, and how much money you can bring in. But you're actually...
I think that was version 1.0.
Okay, that was Trump 45.
Version 2.0 might be the same, but version 2.0 might be something different. Version 2.0 might be thinking about history books and legacy and things that we measure 10 years from now, not 10 months from now. And I think that's something that we need to keep a really close eye on. If you believe that the global trade order needs to be completely rebalanced and adjusted, that's a history book issue. Yeah. I'm not saying I agree with it, and I'm not saying that's for sure what's happening, but I think there are some data points that are saying we might be playing a different game here than what was occurring in 1.0.
Erik, before we let you go, we've got 1 or 2 minutes left with you, and our viewers are wondering, hey, what are my private assets, my alts? What are they doing right now? Obviously, there's a lot of opacity. There's no visibility. Luckily, there's no mark-to-market on these days. I guess you're pretty lucky to have that. Where should they hide? Is there a place to hide? Because if we're talking about the knock-on effects through to the real economy, real estate, that's going to suffer. Other places are going to suffer. You mentioned distress before, but that's a risky game. So where's a place to hide?
Yeah, I think infrastructure is going to continue to be a huge issue both in Europe and in the US. Infrastructure needs are significant, and I don't see the government sort of riding to the rescue right now to put a bunch of money into core infrastructure. I think that's going to largely be outsourced and financed by the private markets. I also think in today's world, I don't agree that the distressed and the credit is going to be super risky. I think when you look at lending ratios and lending rates, there's so much equity coverage going on there that is a opportunistic play with really attractive returns with, I think, a really strong downside.
Data centers were all the rage within infrastructure. Is there a future there?
Yeah, I think you're also continuing to see build out of that. So the AI trend, I think, doesn't go away because of a trade war. I think you're going to continue to see investment back into those areas, and infrastructure needs to finance that are going to be very, very much present.
Brilliant. I think we'll end that one there. I've got to say, I'm getting more correspondence about cheese than I ever thought I would. And mostly from the very exacerbated Swiss out there this morning.
Everyone's upset.
Daniel is a great friend of the show as well. He says, the best quality Emmentaler is mainly exported, also to the US. In Switzerland, I wouldn't touch this kind of cheese. But in LA, I've had it for breakfast almost every day. Daniel, you know we adore you. Thank you very much indeed. Peter, who's also born in Switzerland, he says he thinks he can get better Swiss cheese in UK rather than Switzerland. But you've always got to ask, is it a Swiss product? Is it the real McCoy?
It is.
Personally, I eat the stuff, but it's a bit dull.
Did you know there's a Swiss cheese crisis in the sense that
I did not know there was a Swiss cheese crisis.
They're importing more than they're exporting. I read,
that is
which is very odd. I think I should do some research on the ground.
Yeah, I will always do my cheese. So what is your favourite cheese anyway? Did you tell us?
I'll take an aged Gouda.
An aged Gouda,
Yeah, I'm with you on that.
Yeah, okay, that's fair enough. And the reason why we're mentioning cheese, by the way, in case my bosses say, where on earth are you going? It's because the French look like they've got some form of exception to the tariff rules that are coming in, stripping out some of the booze and stripping out, of course, the key product that is cheese.
Yeah, bourbon, I see, is no longer on the list.
Isn't
so.
that funny?
Yeah, see, we don't
I think he threatened 200% back on European alcohol, didn't he? Yeah. See, we can talk about anything we like and find a business rationale if we try hard enough. Eric, lovely to see you, sir.
Pleasure.
As ever. Erik Hirsch, co-CEO at Hamilton Lane.